Daily stock market update, 16th of February. The US markets are closed for President's Day, but it's a good opportunity to catch up on all the panic and the scaremongering that's going on. First and foremost, the headlines on CNBC are Deutsche Bank warns AI risk in US equities is undermining dollar's safe haven status. Well, the dollar's going to continue being a safe haven just in terms of the macroeconomic size of the country, whilst other countries like China and Bitcoin, non-country assets, you might think are about to remove dollar dominance, we're okay for the near term. And certainly for the period over which we're looking to invest, which is 1, 2, 3, 4, 5 years. So those who are getting panicked by conspiracy theories are probably also flat earthers. If we go to the big headlines out there at the moment, China's tech shock threatens the US AI monopoly and is just getting started. Well, if you remember this time last year, we had exactly the same story coming out of China. So what journalists tend to do is they look through their lists, they see what they read about a year ago, hope everybody's forgotten, then update it, and that's the same old story again. The problem with journalists is they think investing and making money, which is the job of a Google or a Meta or Microsoft, is a one-shot game. So China did this, therefore Microsoft is doomed. Alphabet is doomed. What they don't realize is it's actually closer to game theory, which is we're just starting to learn when I did my economics degree, which is, yeah, they make a move, we make another move. They might make a move to that, we make another move. If you take it in simple terms, that we've done this, they've done that, therefore it's game over, then of course everything's game over, and it's why most people don't make money in the markets. Futures are slightly positive. The S&P 500 futures are up 0.4%. Look, it's a light trading day because the equity market's being closed. Investors are looking at macroeconomic data on inflation coming out this week. Why? Well, because earnings are behind us. Profits announcements coming from companies are behind us. So the next thing they're going to look at is back to interest rates. Are interest rates showing any sign of likely to be rising? What would cause them to rise? Well, if the economy is doing incredibly well. But if the economy is doing incredibly well, then the stocks that we hold should do incredibly well. So it'd be win-win anyway for us. If inflation is rising, that would cause the markets and stocks to dip somewhat because they'll be fearful that interest rates will start rising. It's not going to happen. Rate cut expectations are rising modestly after softer recent data. Okay, so nothing to worry about on the stock front other than the panic. Essentially, we're at the stage where we have nothing to fear but fear itself. There is even people willing to say that the AI disruption narrative is affecting everything. AI, any company that has anything to do with AI should fall. That's the narrative at the moment. And these shrill voices get more and more shriller, as it were, during these periods. What's happening at the moment? Applied Materials up 8%. Who's getting battered? Well, Norwegian Cruise Line Holdings is down about 7%. Not one that we hold anyway. Looking at the UK markets, FTSE 100 slightly high. The UK FTSE 100 tracker, the momentum on that is continuing upwards, and it is a momentum play. It is obviously not growing at the same slow rate of the broader economy. And it's a momentum play because the things that are actually driving it are mining companies, gold is continuing to be a safe haven, and financials, our banks. So Barclays, NatWest are rebounding. Of course they are. They're good ones to buy the dip on for the moment. But if you want to trade, you're almost certainly going to lose money. If you want to invest for the longer term, then you probably want to look beyond just the UK individual stocks and the obsession over them. You'd want to look at global companies, including US ones, obviously, and pick the best out of those. Rate cut expectations for the Bank of England. Yes. Will it happen in the next meeting? Almost certainly not. And that keeps us in the Goldilocks scenario of if we cut, then the expectation is we won't cut again. So that could hit stocks. If we don't cut, the expectation is we will cut in the future. And that keeps the carrot in front of them, stock market donkey's nose, and it keeps it going higher. And that's where we are. So that's pretty good. There is still more money going into Europe and the UK, just moving away from the massive profits they've made in the US. That is not a negative statement on the US any more than if I rebalance my portfolio after Alphabet goes up 60% in a year, as it did last year, and move everything to, say, 20 stocks with 5% in each. That doesn't mean I'm negative on Alphabet's future growth. It just means I had too much money in one company and I don't want to take single stock risk. Okay, so that's the misreading that people have. Oh, there's too much, there's negativity on the US. There isn't. It's a rebalancing into other regions. And the best way to get exposure to, say, the Euro Stocks 600 is an exchange traded fund, or Japan is a Japanese exchange traded fund. But you're only going to have about 5% in your portfolio in it because you're going to have at least 20 securities. Commodities and macro, oil is slightly higher on supply concerns. As long as it's below $80, we're fine. Gold is steady. The expectation across Wall Street, it's going to move higher. That almost certainly means it's going to take a sharper dip below and panic everybody before it does indeed move higher. Think of the markets like a rodeo horse. The job of the market is to get as many people off it as possible. If the job of the market was to keep people on it, it would just keep going in a straight line upwards, because that would be the best way to do it. Clearly, the job of the market is to remove as many people off it as possible. Why? Don't ask why. Ours is not to question why. Ours is just to understand that it happens. And accordingly, the best thing to do to stay on the horse the longest period of time, buy and hold. Because whilst you can make money trading, most people will not. And certainly those who just think they're going to learn it off a couple of videos off TikTok will not. Okay. Asia is attracting more institutional capital. Again, Europe, Asia, UK. That doesn't mean you take a short-term bet on Asia. It means if you want to exposure to certain countries like India, INDA, or China, I'd probably do China through Alibaba, and you look at the volatility on all of these and you'll expect a 30% drop at any given point in any of these assets you own, which is why you only have 5% of them in your portfolio of 20, say, securities, because 30% of 5% means you barely lose 1% impact on your portfolio should they drop that 30%, which is always to be expected. Just as I say, the S&P's expected to drop peak to trough 14%. Of course, the greedy retail client then thinks, oh, I will try and perfectly time this and be 100% correct and make lots more money than if I just bought and hold. The one truth that I've learned about private investors is trading is difficult for them. They shouldn't do it. It's the general rule, just as they shouldn't touch leverage. I hope you've liked the update. More to come. I'm also on Substack now. So if you go to Substack and look up at Great Investments, you'll find me there, or look at my name. You'll find me there, where I post not just videos, but actually long form written articles. If you don't want written articles because you're a visual person, you like videos, then you don't need to look at Substack. Okay. Thank you all very much. Please don't forget, as ever, interact and engage with this video, because if you do that through comments, through saving, through forwarding, that really works well. It goes to more people view it, happier I am, and more of these I do. Thank you.